Great, thank you. Okay, so let's start. I know there's still a few more people coming in, so I'll just let them in as and when. But welcome everyone to the Financial Management 3A Test 1 Masterclass. So focusing on today is Learning Units 1 and 2 only. Your test, which is next week, is only on Learning Units 1 and 2. So that is the focus today. Just so that you are aware of who I am, my name is Claudia Dorosha. I'm one of the lecturers at one of the brands. I also help with development, so quite familiar with the content and with what is required. So please, if you have any questions or if there's something that's not covered today that you are uncomfortable with, you are more than welcome to either pop me a chat on Teams now, or I'll also just drop my email address in the chat. So if you have any questions, you're more than welcome to ask me. I've just dropped my email address so that you have it. Okay. I normally respond within 48 hours. So if you do it this week before Friday, I should be able to do it. The weekends are a bit tough, but during the week is perfectly fine. Okay, so what are we covering today? So these are the main topics that you need to know, or I'm going to cover today, but you also need to know for your test. So learning unit 1, the main principle is economic value added. So that is the only real topic coming out of learning unit 1. There is some theory that you would need to know, but the main purpose or outcome of learning unit 1 is the calculation of economic value added, which we will go through today. Then in learning unit 2, that is the bigger chunk of what is required for your test preparation. And you need to know your present value and future value calculations for different types of investments or loans, for example. And I've listed all that we need to know. So we need to know present value of perpetuities, present and future values of single amounts, present and future values of mixed stream of cash flows, your present and future values of annuities. And there's two types that you need to deal with, ordinary and annuities due. There we also need to be able to apply these formulas in different ways. So we need to be able to manipulate your formulas or the calculations so that we can get different elements, which I will also go through today. And then the other thing that we do need to know is the effective annual rate. So the first part of the session today, I will go through all the different formulas that you need to know, core calculations, and the financial calculator aspect. Your financial calculator is very important for test 1. If you don't have a calculator, it would be advisable that you have one. Or if you are not comfortable with your financial calculator, you're also more than welcome to use the formulas that are available. So we will go through the 3 different ways that you can calculate for each topic for learning unit 2 specifically, so that you can see which one is your most preferable. In a test situation, there are times where they will ask you specifically to use a specific method, which we'll also go through today for an example. So you do need to know the different methods. Try not to just learn one because of just the way that they could ask the question. All right, before I move on, I just want to double check that I haven't forgotten anyone, because a few people still coming in. Okay, perfect. Okay, so let's go through the formulas. So we'll be alternating between this screen, which is the slide deck, which I'll make available to everyone, as well as a online whiteboard, so we can go through the formulas in a bit more detail and have a better understanding of how they interlink. So I'll do that as well for you. But in terms of learning unit 1, there are really 4 formulas that you need to know two come from EVA. So you've got two ways in which you can calculate your economic value added. You can either have NOPAT minus invested capital times your WACC, or you can have invested capital times the return on invested capital less your WACC. So either one is acceptable. It really is dependent on what is given in the question. Generally, the first formula is the one that's most commonly used, but I would still make sure that you know both in case there could be elements in the question that lead you to try and calculate the return on invested capital, which I'll also go through with you today. Okay, the other formulas that we need to know is for the WACC. So your WACC is just another word for your cost of capital or your opportunity cost or your discount rate. It is something that will feature throughout the subject for the semester. So it's not something that you're just going to see now. So it is important that you know this formula. I will go through in a bit more detail on our whiteboard, but in essence, it's really about calculating the weighting of your debt and your equity and then working out a rate that can be used. Then you've got your return on invested capital. The calculation for that is NOPAT divided by invested capital times 100. So that is in case in the question they do ask you or do lead you to use that formula. So it is important that you know how to calculate your return on invested capital in case that comes up. All right, so now I'm going to go to the whiteboard so we can just unpack these formulas a bit more and just to understand how they interlink to each other and how they could potentially be asked in a question. As I said, for those of you that have only come now, we will be spending the first part just going through all the formulas and calculation types that we need to understand. And then what I will do is we'll do some application afterwards with specific past paper questions where we cover different aspects. Obviously, it is not, what I'm showing you is not everything, as in the papers, it's not all the past papers. I've literally just selected 3 questions that will give you a nice idea. It is advisable that you try to look at other past papers or other past question types so you get a feel of how else things can be asked. Okay, so let's switch over to the whiteboard. I'm just going to stop sharing quickly and then just share that. All right, please just confirm that you can see the online whiteboard. I will make it bigger for you. You can just, share a thumbs up if you're able to see. Okay, perfect. All right. So with our learning unit 1 formulas, as I say, you got EVA is equal to NOPAT less your invested capital times your WACC, and then you have EVA is equal to invested capital times your return on invested capital minus your WACC. Just a note that not all the formulas, I mean, there is a formula sheet, but it's very limited. I will share with you an example of a formula sheet from a past paper. But if you also want to see for yourselves, you're more than welcome to go look at the past papers and see the formula sheet for yourself. You will see there's a lot of formulas that are not on the sheet. So it is advisable that you know them, that you're able to memorize them so that you can use them in your calculations. I am going to say that again, not all the formulas are on the formula sheet. So it is important that you understand and know them. All right. Okay, so before we go into the tackling of these formulas, the point of EVA or economic value added is really to assess the value of an entity or a company, is really to see has its value increased or decreased. And what we're looking at specifically, especially because it's finance, we're looking at cash components. We want to make sure that we only include cash items in our NOPAT, and that we only include items in our invested capital that are relevant to those cash flows. So when we go through a question, you'll see that we do take out non-cash items. We do make sure that we capitalize things which under an accounting perspective wouldn't be capitalized, because from a finance perspective, we are seeing that there's economic benefit. So it's very important that, number one, with EVA, that we take out non-cash items from our NOPAT, and number two, that we make sure that our invested capital is a reflection of the economic benefits of the NOPAT items we have incurred. It's very important. Those two must talk to each other. Okay. All right. So as noted here, your NOPAT, okay, specifically, okay, so we must remove non-cash items. Okay, so example of non-cash items could be credit losses, depreciation, anything that they include in a question that is non-cash. And what I mean by non-cash is that we're buying it on credit. Okay, so we haven't used any type of bank, or we haven't used our bank account. We're thinking of accounting purposes. What is also important to not get confused, that using, as an individual, using a credit card to buy something. So if I go to the petrol station and I buy something with my credit card, that is seen as cash by that company, because the bank will immediately pay that company the money. You as an individual will owe the credit card company. Okay, so it's quite important that if they throw in, purchase with a credit card, it's still seen as cash. So don't get confused there. Okay, so NOPAT, we must remove our non-cash items. Then we have our invested capital. Okay, so with our invested capital, basically it's the opening balance of equity and interest-bearing debt. Very important that it's those two items. And when we say interest-bearing debt, we are talking about non-current and current interest-bearing debt. So don't think it's just the long-term one, it's both of them. Okay. So, and the key thing is also that it is the opening balance. All right, there is a trick with the opening balance of equity. You'll see in our question that we have to adjust equity because of its opening balance. So what I am just going to go through now is when we calculate equity. Okay, so just a reminder of accounting principles. Equity is our capital plus net profit less or plus or minus plus net profit, of course, or less a loss, depending. So you'll need to see. Okay, so your equity, the principles of equity do not change from accounting. Equity is still your capital plus or minus your net profit or loss, less your drawings, less your dividends paid. Okay, it must always follow this formula. And this is the reason why you'll see with some of the non-cash items, we actually adjust equity because of the net profit portion. I mean, I'll explain that in the question, but it's because of the net profit, because we need to adjust prior year's net profit to get the correct opening balance for the current year. So it's important that you remember this calculation so that you can understand better. Okay, then with the WACC, okay, so with the WACC, we have a specific formula for the WACC. So in a question, the two things can happen. Well, actually three things. They can give you one, the WACC itself. They can say the discount rate is X. It's very simple. You use that. No tricks there. They can say to you that the interest rate or the discount rate is a percentage of something or a third of a number, so you can calculate it as a normal calculation, so no formula being used, or they can ask you to do it as a formula, okay, which means that they actually give you the debt and equity portions and you have to weight it.
Yeah.
Okay, so just to remind ourselves what the WACC formula is, it's the weighting of debt times the return on debt times 1 minus the tax rate plus the weighting of equity times the return on equity. Make it a little bit bigger, then you can see it better. Okay, so the weighting of debt, the D is for debt, times the return on debt, times 1 minus the tax rate, because our debt is always at an after-tax rate, and then the weighting of equity times the return on equity. You've got to add those two together. Okay. So the question that I have for you today won't ask you to calculate the WACC, but there are questions in your textbook where they actually ask you to do that. So it's important that you go through those questions in Learning as One, so you understand if they incorporate the calculation of WACC in your question, and you can at least answer that. Okay, I'm going to pause there if there are any questions before I move on to the return on invested capital. Okay, so there's a question on the group that says, if we prefer using the formulas, do we still need to use the financial calculators? No. Okay. So to answer you, Nilam, you can use the formula or the financial calculator. Okay. The only thing that may be prescribed is the use of financial tables. And I'll show you a question like that where you've got to use the financial tables. But normally they will interchange the formulas and the financial calculator, because using either one gives you the same answer. The financial table one is a rounded number, so it's slightly different if you do all three calcs. So that's the only one where they normally prescribe. But yes, you can choose what you prefer. So use what you are comfortable with and are able to answer the question. Okay, so either formula or calculator, your choice. Right, then the question is, what is RD? That is the return on debt. Okay, so I'm just going to also answer here in the chat, so that you guys have that in case someone else comes back. Okay. All right. Then the other question was, explain NOPAT again. Sure, no problem. Okay. So NOPAT is net operating profit after tax. I'll actually go back to that whiteboard. Okay, and I'm going to actually add it here as a little thing for us. Okay, so it's net operating profit after tax. Okay, and what is critical from a finance perspective, we are trying to get the cash balance. Okay, so yes, the questions in the textbook don't give us in-depth information. So if you were in practice, you would literally need to know in every single item what is the cash and non-cash component, so you can adjust it. Because when you're dealing with listed companies or even medium-sized companies, it's mixed. Your sales will be credit and non-credit, so it's quite mixed. So you find that when you're doing your NOPAT, it's quite complicated. Okay, for us in this module, it's pared down, so they will specify what is non-cash, or at least give you indicators of what's non-cash. Okay, so your NOPAT is net operating profit after tax, and we are trying to get the cash balance for that. It needs to be a cash item. So we remove non-cash items, like I said here. So you remove your non-cash items. Okay. Does that answer your question, Mr. D? Yes, so there's a question about, perfect. There is a question about whether it's being recorded. Yes, the session is being recorded and will be shared, as well as my slide deck, as well as the PDF version of the online whiteboard, as well as the papers that I'll go through with you today, as well as the solutions. All of that will be shared. So I'm just posting in the chat so that everyone knows. Okay, so there's a question. If we give you net profit before tax, must we multiply it by 0.72 or 0.73? So that's all dependent on the tax rate. Okay, so remember, NOPAT is net operating profit after tax. So you're trying to get your profit after tax. So if they give you profit before tax, you need to start with your profit after tax number. If your tax amount, which they need to specify in the question, is 28%, you will use 0.72. If your tax rate is 27%, you will use 0.73. Okay, so it all depends on the tax rate. The question should specify 27% because that is the tax rate currently in South Africa for companies. So that should be in the question. Okay. Okay. Right, so I've just answered all those questions there. Alrighty, then the other EVA formula. So the other EVA formula, the investor capital is exactly the same as what I've noted here. Equity plus interest-bearing debt. The interest-bearing debt is both current plus non-current, all right? Your equity is still calculated the same way. The only difference is your return on invested capital. Okay, so that's the only thing that's really different. So it's your return on invested capital. Okay, your return on invested capital is a percentage. Okay, so please, when you're doing the calculation in the brackets here, it's actually a percentage. So I'm actually going to note that down. Use different color. So that is a percentage. Okay, so in here is a percentage. Your ROIC, your return on invested capital, and your WACC are both percentages. So you're saying, what's the difference of percentage times my invested capital? And then your return on invested capital is a formula. Okay, so your return on invested capital is basically your no PAT divided by your fixed assets less your net working capital. Okay, so when I say fixed assets, it's basically your non-current assets. Okay, so your fixed assets. Okay, maybe I'll actually change that to non-current assets so that you understand. Non-current assets less your net working capital. Okay, your net working capital is a principle from financial management 2A, because as you all should know, that everything in finance works on from each other. So the formula is exactly the same as what we had there, and I will just note what that is. So your net working capital formula is basically your current assets less your current liabilities. Okay, so make sure you still know what are your current assets, what are your current liabilities. Okay, because you could just be given a list of your current assets and current liabilities, and you need to identify them and then work out your return on invested capital. Anything's possible, right? Okay, so that's your return on invested capital. As I said, both of them are percentages. Your return on invested capital is a percentage, your WACC is a percentage. Calculate the difference between those percentages, and that you times your invested capital, and your invested capital amount is exactly the same as what we have noted here. All right. Any questions on EVA? Like I said, we'll do a question in the second half where we practice that. Tristan, I see you have a question. If you want to pop it in the chat or go off mute. Can't hear you if you are asking me something. Okay, I'm going to assume it was just no question. But if you have a question, please pop it in the chat, then I'll answer. Okay. All right, so that's our learning unit 1 formulas done. Those are the ones that we need to know. That's what we need to understand. Like I said, we'll do a question just now where we're going to apply some of these formulas. All right, so now let's go to learning unit 2. I'm going to share the deck, the slide deck, where we go through all the formulas for learning unit 2. So learning unit 2, there are a lot of formulas to use, but a lot of them are quite similar and have an inverse relationship. So if you understand that present value and future value have an inverse relationship, which is indicated by the n. So you'll see with the present value, it has a negative n, future value has just a positive n. And then when you look at single amounts versus annuities, you'll see that then we start bringing in payment in. Okay. So the first type of investment or transaction that we could be asked is the present value or future value of a single amount. So it's quite important that we understand what these are. So if I say single amount, what am I saying? It's a lump sum. I have an amount and I put it away to incur interest. I don't pay any amount monthly. I don't pay any amount yearly. I don't take any amount out. It's just one amount that I put away. Okay. It's very important because when you have a question, there will be multiple types of investments or transactions, and you need to be able to identify, is this a single amount? Is this an annuity? What do I need to do? Is there compounding or no compounding? Okay, so it gets complex because we put it all together in a question. It's not straightforward. We just calculate a lump sum. Okay, so it's important we understand that. So when we say single amount, we're talking about a lump sum. We take an amount, we put it in to an investment account, it incurs interest, and we get amount out at the end. Okay, so the formulas that I have here have been adjusted for compounding. So if you look at your textbook, they will not have the M in there because when you cover this, it's before you've covered compounding. But in essence, compounding can and will be asked in every question. Obviously, if there's no compounding, M is 1 because it just means that your interest rate is for that year. All right, so your present value form is future value times 1 plus R over M minus N times M. And this principle of M compounding, so dividing your R, your discount rate by M, and multiplying your N by M is something that you have to bring through into your calculators as well, which we'll go through as well. So it's not something just for formulas, it's also in the calculator. For the N and the interest per year, we have to times and divide respectively, but I'll go through that as well. Okay. So this is the present value of single amount, so a lump sum, right? Then we move into present value of an ordinary annuity. So at the beginning of the session, I did say to you that there's two types of annuity. We have an ordinary annuity and we have an annuity due. An ordinary annuity means that you pay your monthly amounts or annual amounts at the end of the period. Okay, so I'm going to say that again. Ordinary annuities is when you pay your amount at the end of the period. Okay, so and an annuity is when you're paying the same amount over and over again. That's how you know. Okay, a single amount, you have a lump sum once off, that's it. An annuity, you have an amount that's paid repeatedly, okay, for a set period. because then we have perpetuities, okay? But for annuities, you pay the same amount for a set period. And it's an ordinary annuity means you pay it at the end of the period. So if I pay an amount monthly, I'm paying it at the end of the month. That's an ordinary annuity, okay? So with the formula, it's quite similar to your present value and future value formula. The only difference is that we've brought in PMT instead of your future value. And then we are, in essence, minusing the interest rate. That is it. And then dividing your R. Again, I've included compounding. Compounding will always be included in your question, so you cannot ignore it. So in your formula, make sure that you always include the M if you are using the formulas to answer questions. All right. Now, annuities due. As I said, ordinary annuities is for payments or payments that you make, repetitive payments at the end of a period. Annuities due are repetitive payments that you make at the beginning of the period. Okay, so if we're paying monthly amounts, I pay it at the beginning of the month. So what happens now is you'll see there's an additional payment or an additional interest depending on present value or future value. Okay, because what's happening now, because I'm paying my amount at the beginning of the month, I have a whole month extra where I'm gaining interest, or a whole month extra that I'm paying an amount. Okay, if I was paying at the end, for example, if I was paying an amount in March, I'm waiting until the 31st of March to pay. So only from basically 1st of April onwards am I getting interest. Whereas if I paid at the 1st of March, the whole of March, I would have gotten interest. Okay, so that's why there's extra PMT here and an extra factor for the discount. Okay, again, M or compounding periods is factored in. Okay, any questions there before I carry on? Because there's lots of formulas. Okay, so Tristan has so I see Tristan, I'm just going to go back. I see you've asked a question about the return on invested capital formula. If it's NOPAT divided by invested capital. Yeah, I suppose you could say it is that. The only thing is that I would prefer that you use fixed assets minus your net working capital, because there are some elements of assets that are still included in the denominator for invested capital. Okay. But if you wanted to use our invested capital, like we said, equity plus interest-bearing debt, that's also fine. Okay. I know from a more practical point of view, sometimes there's items in your non-current asset portion that you want to factor in, but obviously that's looking at it more complexity. Okay. All right. Now, the next formula is present value of perpetuity. So perpetuity is quite simple formula. Basically, what we are saying is we're receiving an amount or paying an amount to infinity. Okay, so there's no set time frame. It's very rarely that this gets asked, because it's very rarely in practicality that we have perpetuities. There's very few investments that you can actually invest at any of, if I look at an Old Mutual or even Sanlam, any of those where they would actually offer a perpetuity where you can just invest forever and ever and ever and ever and ever. Even your retirement plans, it normally goes until your death. So there's still some, there is a set time frame. But it's just good for you to also know. And again, in your textbook, they didn't factor in compounding. So again, with this compounding, you need to divide your R by M. Okay, same principle. Whenever there is M or compounding periods, you divide your discount rate by M, you multiply your N by M. No matter what formula you're using, no matter if you're doing financial calculator either. Same principle every time. Okay. Right, then we have the present future value of a mixed stream of cash flows. So with the mixed stream of cash flows, there are no formulas. Not that there are no formulas, but in our module, we don't show the formulas because they are quite complex. We rely on the financial tables and the financial calculators. Same with all the other types. We also have the financial calculator and financial tables. You can use it for everything. But with the mixed stream of cash flows, we only use financial tables or financial calculators. When we talk about a mixed stream of cash flow, what are we saying? We are saying that there are multiple single amounts okay? Multiple single amounts, but the amounts are not the same. So that's what differentiates a mixed stream of cash flow to an annuity. Okay, if we had 4 years and the cash flows were the same for every year, that is an annuity. But as soon as the cash flows for each year are different, then it's a mixed stream of cash flow. Okay, it's very important that we understand this, because if we don't understand that, then we're going to use the wrong calculation, the wrong formula. Okay, so if I didn't pick up that it's a mixed cash flow and I use an annuity formula, I'm not going to get it right. Okay, so it's very important that we understand that. Mixed stream of cash flow, there are different cash flows every year or even every month. Normally your questions are yearly based, but you can also have monthly. And we therefore don't use a formula. We use financial tables or financial calculators. All right, then we have effective annual interest rate. Okay, so this is a concept that was covered in Financial Management 2A and tested then. So it does come back. What an effective annual interest rate is, it's basically your discount rate factored for compounding. So it doesn't necessarily pitch up in a complex question where they ask you to calculate the effective annual rate and then use that. Normally it's a separate question where you need to calculate the effective annual rate and then compare investments. That's where it normally comes up. And quite an easy formula, it's 1 plus r divided by m for compounding periods, and then m, and then, or to the power of m, and then you minus 1. So it's quite a simple formula, quite simple to apply. And again, we're trying to work out what is our interest rate that reflects compounding. That's really the purpose. Okay, so we're not going to take a break. I'm going to go to the whiteboard now so we can just reiterate these formulas, and I can go through now what happens when you use the financial tables, what happens when you use your financial calculator. Okay, so there's a question here, Nishad, about if we must show the formulas or can we just do the calculator. So there was a question earlier, Nishad. So it's really, you decide what you want to use. If you use the formula, you write down the formula because you get marks for that because you've memorized the formula. If you're going to use the financial calculator, then you need to show the elements of the calculator, and I'll show you what I mean by that. The elements of the calculator that you are inputting onto your calculator, okay, because you get marks for that. So if I'm putting present value, I'm going to write PV. If I'm doing a future value, I'm going to write FV. Okay, so that's what you need to do. Okay, so let me just answer this question here. Okay, so then for Mr. D, would I mind explaining the difference between annuities and ordinary annuities? Perfect. Okay, so I will say it again. Ordinary annuities is when you make a payment of the same amount repeatedly, okay, at the end of the period. Ordinary annuities is when you make a payment or you receive an amount of the same amount repeatedly over a set period, but it's at the end of that period. Okay, that's an ordinary annuity. And then annuity due, that's what we call it. So an ordinary annuity and then annuity due. An annuity due, we either pay or receive an amount repeatedly for a period at the beginning of the period. Okay, so if it's a monthly amount, I'm receiving it at the beginning of the month. If it's a yearly amount, I'm receiving it at the beginning of the year. That's the difference between ordinary annuities and what we call annuities due. Okay. If you just see annuity, they're normally referring to ordinary annuity. Okay, so they normally keep the annuity for the ordinary, which is the one you pay at the end of the period. And then the one where we pay at the beginning, they'll call it annuity due. Okay, so if you see annuity, more than likely, without reading the information, it's the payment at the end. Okay. Okay, I'm just going to also write it against your message so that you have that. Perfect. Okay, so let me now go to our whiteboard so that we can go through those formulas. Right. So just put or just give me a thumbs up if you can see, just to make sure I haven't lost anybody. Should be seeing the whiteboard. Okay, brilliant. Thank you. All right. So learning unit 2 formulas. Okay, so on the left is the slide deck that I showed you, the present and future value of single amounts, and we have our formulas. As I said, there are two other methods. Okay, we have the financial table method and we have the financial calculator method. All right. As I've said before, and as I've written in the chat, you can choose which method you want to use unless the question specifies. Okay, the only time the question will specify is if they want you to use financial tables. And the reason for that is because the answer with a financial table is different to when you use a formula and a financial calculator, because your formula and financial calculator is very precise, whereas your financial table, your factors are rounded. Okay, so that is really the only time. So with your financial table method, okay, so I give my students a formula so that you remember, but in essence, when we are calculating the present value, we're saying future value times our present value factor. And we get that factor from the tables. Okay, so those tables, don't need to memorize it. They will be given to you in your paper. Okay, I will also run through how we use that for one of our questions because I have a table as well. So future value times present value factor, and future value is the other way around. We say present value times a future value factor. What is important is if we are doing our calculations for single amounts, okay, please, we must use the table for single amounts. In other words, it must not say annuity on it, okay? So I'm going to repeat that again. Use financial table for single amounts. So not the annuity table. Okay, because you basically have in your textbook, you've got 4 tables. So you need to be able to understand which one needs to be used. Okay, so I'm going to say again, if you're doing the financial table method and you need to find your factor, you must use the financial table for single amounts. So so not the annuity, the one that tells you that doesn't have annuity in the heading. Okay, I'll show you what I mean by that in a bit. But in essence, it mustn't say annuity. Then you know you've got the right table. Okay. And then obviously, if you're using the present value or future value, you must look for present value on the table or future value on the table. It says basically present value. It says it's got present value on there, so you can look at it. All right. Then when you're doing with financial calculator method, this is what I was talking about earlier. You don't have to write down the formula if you're using the financial calculator method. What you must do is show the elements. Okay, so IR is your rate. Okay, so it's our R. FV we know is future value. N is for your periods, and PV is your present value if that is what you're calculating. Okay, if you're doing your future value, the only thing that changes is your present value and future value. That's it. Okay, so I/year, or yeah, it's basically interest per year. That is your R. That is your R in your formula. Okay. So when you use a financial calculator, please don't forget to write. You get marks for just writing down these elements and then the values next to it. Okay, so you get marks for that. If you just put the answer PV and it's not right, and there's none of these there, marks can't be given to you. At least if you get some of this right, you can get some marks. Okay, so please make sure that you always include that for your financial calculator. Okay, so with your ordinary annuity, the only thing that changes now under the financial table method is that we are taking our payment. So that is the amount that repeats. Okay, that is the only thing that's different. So this is the only thing that's different. Okay, that is it. And then again, we get a present value factor and a future value factor, and that we get from our table, making sure that we get this from our annuity table. Okay, we must get it from our annuity table. And it must be the ordinary annuity. And how do I know that? Because it doesn't say annuity due. That's how I know. Okay, but it says annuity on your table. Okay, so you've got to get it from your annuity table. Same with the future value factor. Okay, then your financial calculator method, again, same as before. We write down all the elements on your financial calculator. The only difference is now we have PMT, which is the annuity amount, the amount that repeats. That's the amount that comes through. Okay, so I'm just going to note that, the amount that repeats. Okay. All right. Then with annuities due, so again, here we did the ordinary annuity, which is we receive the amount, we pay the amount that repeats at the end of the period. Here we're doing with annuity due, and the only difference is that we have now make the payment at the beginning or receive the payment at the beginning of the period. Okay, so with your calculators, the most important thing is to make sure your calculator is on beginning mode. Okay, it can either be BEG for beg or BGN for begin. So you just need to check what your calculator says, and you must make sure that is on. That's the first thing you do. Okay, if your calculator doesn't say that, then you're not going to get the answer right no matter what you do. Everything else can be right, as in the values you punch in, but if it's not in beginning mode, it's going to be wrong. Okay, so that really is the only difference. With our financial table, it's really just about which factor we use. Okay. Right, then with our present value of perpetuity, there's only a formula. There's no financial table method and there's no financial calculator method because we don't have a set period. Your financial table is reflected based on set periods, and your financial calculator is also reflected on set periods. So for perpetuities, we only use formula. That's it. Okay. Right, then with your mixed stream of cash flows, we use financial table method or financial calculator method. Okay, with your financial table method, the present value factor and the future value factor, that do both of them, all the factors that we're using, is for a single amount. Okay, so you're using the table for a single amount. And the reason for that is because you have to calculate the present or future value of each separate cash flow and treat it like it's its own amount. So you use your financial table for your single amount. Okay, don't use the annuity table. It's for financial table for single amount. And then with your financial calculator method, the only thing that's really different is now we are putting in all the cash flows. Okay, so I've got cash flow in because you don't know how many cash flows there could be, but you basically punch in all your cash flows. Okay, and then this is what we've done here, or what I've put here. These ones here are all for when our cash flows at the end of the period. Okay, so when there's a cash flow at the end of period, there's no beginning mode, right? When we've got a cash flow at the beginning of the period, if you're using calculator, we have to have beginning mode. Okay, so a reminder, if we are doing anything with beginning mode or cash flows at the beginning of a period, we must include beginning mode on your calculator. Okay, and then depending what we're calculating, are we calculating the present value or the future value? And we call it net present value, net future value. Okay, and then the last one, your effective annual interest rate. No financial table method, but you can calculate it on the calculator where we punch in period per year. That will tell you how many periods we're compounding for. You punch in the interest rate and then you calculate for the effective percentage. Okay. Any questions on the formulas, the financial calculator from a principle perspective? We are going to go into questions now, but anything in terms of principle, how to do that? Okay, so Caleb's asking which formulas will be included in the formula sheet and which will not. So I don't have a set idea of what's going to be included, but my suggestion is to look at a past paper. I will show you an example today of what a past paper formula sheet has looked like. And generally it should remain the same. Yeah, that will maybe guide you, but it's not a lot. It really isn't. Okay. Then Mark asked me for annuity. Do we use annuity table? Yes. Okay. Any other questions? Okay, so I see there's a question about which buttons to go through after filling in our cash. I just want to make sure, Tayran, is that for when you've got a mixed stream of cash flows? Cool. All right. Okay, so I'll see if I've got time today. The other thing I can do is I've got financial calculator guides for both Sharp and HP. So I'm not sure which calculators everyone has. Most should have the Sharps. So I will share that as well. So you've got those financial calculator guides. So literally it'll show you exactly how to punch it in for a cash flow to calculate the NPV. The only issue with the Sharp, it doesn't really show you how to do one for net future value, which I'm trying to get that. But I'll see what I can do because we're going to do a question on cash flows, but it's going to be based on one of the other methods. And then if we have time, I'll show you. Otherwise, I'll just drop the guide. And then if you're still struggling, then I will help you. Okay. And then Scott's saying, yep, I'm failing. No, you're not. Okay. We're not going to fail. We can do this. It's really not bad, the content. Like, we're going to look at questions now. You're going to see. Okay. Let's see what else. Could you explain to the financial calculator when it's monthly or quarterly compounding? Yes, so I will go through that, how to use the calculator when it's monthly or quarterly compounding. We're going to go through a question where we do that. So I'll show you that. Okay, and the other one. Okay, so for cash flow at the end of the period with CFO always be 0. Okay, so for cash flows at the end of the period would cash flow 0 always be 0? Okay, so normally yes, unless there's some kind of trick in the question where they said we've put an investment amount and then we only start paying after that. Okay, so unless they say something like that, but yes. Okay. Then someone else said, what changes must you do to the calculator for monthly, quarterly compounding? Okay, so there is a change you can do on the calculator for monthly, quarterly compounding where you set your period per year. But my suggestion, because the sharps aren't that friendly and most people here would have a sharp, I would not do that. Make sure your period per year on your calculator is 1, and then all you do is you adjust your N and your rate, like the formula where you got divide by M and times by M. And I'll show you what I mean by that. Because then if you don't fiddle with the period per year, because sometimes if you fiddle with it and you forget, when you do a subsequent question, you're going to get it wrong no matter what your numbers are. So my suggestion is don't fiddle with that period per year. Rather adjust your N and your interest so that it factors in the compounding. You get the same answer, okay? And it's just the safer option, no matter which calculator you're using, okay? Okay, alrighty. Um, yeah, so Kanya, I do have a guide for both HP and Sharp, so I'll share both. Yes, I'll share that as well. So I've got the guide for HP and I've got videos which I'll share links to as well. It helps. Anything helps with the calculators, okay? Sometimes it's easier to watch someone else do it. All right, good. Okay, so options. Do you want to take a 5-minute break or do you want to push on to our questions? You can just pop in the chat what everyone prefers. Okay, so Caleb's saying push on. Okay, okay, looks like we're pushing on. Okay, good. All right, let's push on then. Righty. So we're going to start going through past paper questions so we can see how this is applied. Okay, it's all nice and dandy to do the formulas in that and look at the examples in the textbook, but then when you get the questions, things are a bit different. All right, so we're going to start with EVA, a Learning Unit 1 question, so that you can get a feel of what this would look like. This is from all my questions today from a 2024 past paper question. I've just selected those ones because they gave a nice view of what could be expected. There are other ones, of course, but that's just the ones that I chose for today. Okay, just give me a sec to share. All right. Please just thumbs up that you can see it. Make it a bit bigger. Okay, good. All right, so this is a EVA question, 15 marks. So with any question, the first thing you always look at is mark allocation. 15 marks is more or less 20 minutes for you, because now what they've done is they've changed it. It used to be a mark a minute. It's now 1.2 minutes a mark. Okay, so if I say 15 times 1.2, it's 18 minutes. So we should finish this in 18. Obviously, because I'm doing it together with you, it will be a bit quicker. And the next thing we do is we always look at the required. So literally they say here, calculate the economic value added for 2023 only. So they're telling you exactly what to do. It's not complicated. Most questions they'll say calculate the EVA. One other way they could do is comment on the increased value of the company. They could ask you that, but I haven't really seen that before. But it's normally calculate the economic value added, or EVA. Okay, so standard. All right, so I am just going to I'm actually going to share my window, because I'm going to bring up an Excel sheet and then we can actually work through it together. And then you can see how we would approach this question. Okay. All right, so I'm just going to share my actual window. On my screen. Okay, can everyone see the past paper question, and then next to it an Excel sheet? So to make sure that you're seeing what I'm doing. Good. Okay. All right. See, there's a hand up. Does someone have a question? Okay. I don't think they have a question. Okay, if you have a question, just drop it in the chat and or come off mute and just ask. I don't mind also doing that. All right. So obviously they've asked us for the EVA. So the first thing that we do always is we write down the formula. Okay. Well, before that, we need to just read through the information. So we've gone through the mark allocations, 15 marks. We know it's going to take us 18 minutes. How did I do that? I said 15 times 1.2, because I know it takes me 1.2 minutes per mark. So it's 18. I know it takes me 18 minutes. That's how much I have, okay? Just for me to know. Then I know I've got to do the EVA. I've got to go through all the information. So let's go through the information, and then we can see which formula would be appropriate. Are we going to use the first formula, which is NOPAT minus invested capital times WACC, or are we going to use the other one where we have to take the return on invested capital and minus the WACC? All right. Okay, so it says we have been provided with below information related to Legendary Limited for the years ended 31st December 2023 and 2022. So we've got 2023 revenues and profit before tax. Okay, what's critical with EVA? Remember, it's profit before tax. We always want the profit after tax. So we can already see that they're going to probably ask us to incorporate tax. Then we've got our extract from our statement of financial position, and it's equity and interest-bearing bank loans. So remember, our invested capital is the opening balance of equity plus the opening balance of interest-bearing debt. All right. And here they've actually given us the dates. They are telling us that these balances here are opening balances. Okay, very important. And we know that we are doing the EVA for 2023. And the year ends December 2023. Okay, so all important information. Okay, then it says the tax for both years is 27%. So as there was a question in the chat about do I do 0.72 or 0.73, because it is 27%, I'm going to say 0.73. And how do I get 0.73? I'm saying 100% minus 27 gives me the 73, which in decimals is 0.73. Okay, then they've given us the weighted average cost of capital is a third of the tax rate percentage. So remember when I said with Learning Unit 1, they can either give you the WACC or discount rate, they can either make you calculate it off several numbers, which is what they've done here, or third one is they can ask you to use the WACC formula. Okay, so in this one, there's no WACC formula, but as I said, there are questions in the textbook where they ask you to calculate WACC. Okay, then it says, at the end of 2020 and 2023, Legendary Limited incurred 440,000 each year in a marketing campaign to boost the sales of new products that it had launched. The company is expected to derive economic benefits evenly from the expenditure over the next 4 years, starting from the beginning of the year following the year in which the expenditure was incurred. All right. So what is important to note is that when you run a marketing campaign under accounting principles, it is an expense. Okay, we don't capitalize it. It's not an asset. We don't then amortize or depreciate it over its useful life. However, for EVA and when we are doing financial management calculations, we always try to understand the true nature of a cost. So in this case, the marketing campaign, although for accounting purposes would be an expense, for financial management, the company has identified that it will derive economic benefits, okay, which means in essence that we need to capitalize it and then show that it's being depreciated or amortized over its life. Okay, so this is something that's contradictory to accounting principles. All right. And they've told us it's over the next 4 years, and we start from the beginning of the year following the year in which the expenditure was occurred. So we start not in this year, but the following year. Okay, so that's important to also note timing. Okay. Then they give us included within profit after tax is the below. So they've got depreciation, the same for both accounting and tax purposes of 300,000 Rand each year. All right. So the reason why they include this is because depreciation is a non-cash item. Okay, so we are meant to take it out of our NOPAT. And I know that in your textbooks, they don't show you that. Okay, but depreciation is a non-cash item, but the tax impact of doing that is the same. Okay, so that's why in your textbooks, a lot of time, your depreciation and tax effect is the same. So they don't show you because the net impact is null. All right. But in my solution and what I give you today, what we go through, we're going to show that it's a non-cash item and that we're factoring in the tax. Okay, it's important that we do that. All right, then there's interest expense of 120 and 87500. So with interest expense, we have to take it into account into NOPAT. Why? Because we have interest-bearing debt. Okay, that is why we're bringing in the interest expense. If we didn't have interest-bearing debt in our invested capital, we wouldn't worry about the interest expense because more than likely it is a non-cash item anyway. Okay, but because we have interest-bearing debt, we must make sure we include the interest expense. It's very important, right? Then your credit losses. Okay, we've got 60,021, 80,000 2022, an improvement on 2022 by 15,000. So this is a non-cash item. Okay, credit losses are your bad debts. Bad debts is a non-cash item. So we have to remove it out of the NOPAT. Okay, because it doesn't belong there. Right, then we have salesman commission of 250,000 2022, an increase of 10% on this figure for 2023. Okay, so commission is a cash item. Okay, because we pay, if you're in the sales force, you want your money then and then. Even salaries and wages, you pay your people. You don't pay them on credit. So your salesman commission is cash. Therefore, we don't do anything with it for this question. Okay, because it's a cash item. We want it in the NOPAT. All right. Everyone comfortable there? Okay. Just checking. I see there's still someone with a hand up. Okay, cool. All right. So now we need to tackle the question. So the first thing we do, we're going to write our formula down. Okay, and I've chosen to use the first formula. The reason is because that is what is available to me. And plus, for me, that's an easier one. Okay. I don't have to now get the net profit, invested capital, and divide and get the return on invested capital, etc., etc. No. Okay. So I'm using that formula. Okay, the first part is I've got to calculate my NOPAT. All right, so with our NOPAT, the first thing we always start with is our profit after tax. Always. Okay, that's what we start with, right? So in this question, they didn't give us our profit after tax. They gave us our profit before tax. So what we need to do is we now need to calculate. Excuse me. Okay, so we have to take our profit before tax for 2023 because that's what we're doing this for. Okay, so we take our profit after tax, we take our profit before tax, 680,000, and we times it by 0.73. Where do I get 0.73? I've said it's the 100% minus 27%. Okay, so if I calculate that, at 496,400. Right. Now I've got to go through all the different things that are happening in my additional information. So I'm going to tackle firstly the marketing campaign because that's the first one. Your weighted cost of capital comes later when you do the formula. Okay, so when we come here, I need to add back the marketing campaign. Okay, why? Because it's no longer an expense for financial management. Okay, it's been treated as an expense. I don't want it in there. I'm going to capitalize it now because it has economic benefits. So I'm going to add the marketing campaign. Okay, so I'm adding that back. The next thing I'm going to do is I'm going to deduct the amortization from the marketing campaign. Okay, because if I'm saying this marketing campaign has economic benefits, it means that I'm going to amortize it over the period. All right. And we just call it amortization because it's seen as an intangible asset in essence. When you work with intangible assets, you call it amortization. When you work with fixed assets, we call it depreciation. Okay, and how do we calculate that? We're taking the 440 and we're dividing it by 4 years because it said that we would derive it over the 4 years. And we said we would derive it over the next 4 years. So we had incurred expenses in 2020. Therefore, we will have amortization in 2021, 2022, 2023, and 2024. So we are in 2023. It means we will have amortization. So we divide by 4. 110,000, and we're going to deduct that. Okay. Now we're done with this for now. Okay. Let's move on to the next one. We're going to work with our depreciation. So like I said to you in your textbooks, I don't show you this, but I always like to do it because then it shows that I understand what's happening and the reason why the net impact is 0. So I'm going to add back the depreciation, which is 300,000. I'm then going to deduct the taxation that is as a result of that. And they said to me it was the same value. So you will see in your textbook and in most questions, the net impact here is 0. Okay, obviously in real life, that cannot happen because we have deferred tax. So this will always be different. All right. Okay, then we're going to do our interest. So remember I said we need to include our interest. Just give me a sec. I see someone's got their, oh, wait, let me just answer some questions quickly. Okay, so, all right. So before I come back to showing my screen again, why do we capitalize the marketing campaign if it was only implemented at the end of 2023? Just read the question and I'll show you that now. But the question says that we had incurred those expenses in 2020, 2021, 2022, and 2023. And from the year after, we then have incurred economic benefits. So it's important that we start taking account in 2023. I will explain that again when I re-show my screen. Okay, so let me just reshare the window. Okay, so I'll answer that. Yeah, there we go. So JR, we are adding back depreciation because it's a non-cash item. Okay. Okay, so then with interest. Okay, so with interest, we need to factor that in because, first of all, we are working with interest-bearing debt at the beginning of the period, and this interest expense was not there. So what I mean by that, your interest-bearing bank loans is an opening balance. Therefore, the interest that needs to be included in NOPAT, well, we shouldn't have interest in there because we've got the interest bearing of the previous year. Okay, so we're going to add that in there. So our calculation, and always has to be after tax, we take the interest for 2023 times 0.73 because our interest rate is 27%. 63875. Okay, let's see what else we need to look at. Credit losses. So now we still got to factor credit losses because it is a non-cash item. So we are adding credit losses. And your credit losses based on here for 2023 is the 80,000, but then we're saying there was an improvement by 15,000. So we are minusing the 15,000. And the reason why we're minusing is because we're saying when we improve on our credit losses, there are less credit losses. I see there's hands up here. I've got JR with a hand up and guest unverified with a hand up. Do you guys have questions? Okay. I did see the question in the chat and I've answered it, but I'll go back in just now to check. Okay. All right. So we're going to add back our credit losses. Cool. Now the salesman commission, I mean, technically we don't really need to include it, but I am just going to okay, salesman commission has no impact. I'm just putting it there so that you can see. I mean, you wouldn't really include it, but your salesman commission has no impact because it's a cash item. I'm just putting it in there so you can see what the impact would be so you understand. Okay. Now that we have all those values in, we can now sum it. Now we have our NOPAT. Okay, now we need to calculate our invested capital. Okay, so with our invested capital, We always start with our opening balance. It's got opening balance of equity. And then our interest-bearing debt. Okay. So the equity they gave us, they said to us, the equity is here, and they gave us the 1st of January 2023. So it's the 3,200. And the interest-bearing debt they gave to us. Okay. Now what we need to do is add the marketing campaign, but only the portion that needs to be capitalized. Okay. So this part's quite tricky because we have to work out how much economic benefits have been incurred. Okay, so if we look here at this question, we know that 440,000 was occurred in 2020, 2021, 2022, and 2023. We know that it also says that we expected to derive economic benefits over the next 4 years, starting from the beginning of the year following the year in which expenditure was incurred. Okay, so what that means is if we incurred expenditure in 2021, only from in 2020, only from 2021 do we have an economic benefit. Okay, so 2021 and 2022 and then 2023. Okay, because we're dealing with an opening balance, I only need to factor in the amortized amount for 2021 and 2022 because that closing balance at the end of 2022 will be my opening for 2023. Okay, so how do we calculate that? I'm saying the 440, which is what was incurred, divided by 4, we're multiplying by 2. Why am I multiplying it by 2? Because for 2021 and 2022 is when I had economic benefits. It only started, even though I incurred expense in 2020, the economic benefits only started the following year. Okay, so this one is a bit complicated. Okay, so that is what we add because that is what we've realized as an asset. Okay, then the other thing we also have to do is we have to take into account the impact on equity. Okay, so remember when I was showing you on the, let me see if I can actually show it to you now, on the whiteboard. Remember I said to you, we got to remember how equity is calculated. It's capital plus or less net profit or loss, less drawings, less dividends paid. So any impact to net profit has an effect on my equity. Okay. So here I've got to add my credit losses for prior year. Okay, why? Because the credit losses for 2022, the 80,000 would have an effect on my closing equity balance for 2022, which means it would affect my opening balance for 2023. Okay, so I have to add it. Okay, please, this is a common thing. So if you have any kind of non-cash expenditure, if you have credit losses, or if you had any kind of non-cash expenditure that was incurred in a prior year, you've got to factor in how it affects my equity. Okay. Or my net profit of the previous year, which affects my equity. Okay, so we should get 5350 as our invested capital. Okay, now I can apply the formula. Okay, so I've got here VA is equal to NOPAT less my invested capital times my WACC. Okay, so we know it is equal to my NOPAT, which is 955,275 less my invested capital, which is 5,350 times my WACC. So now with my WACC, there's a calculation because they told me here it's my weighted average cost of capital is a third of the tax rate percentage. So I've got to take my 0.27, I've got to times it by 1 and divide by 3 because it's 1/3. Okay, so if I had to solve that, okay, I should write it separately. And there's your answer. Okay, and if they had to tell you if they had to ask you whether the company has value or not, how do we know that? As long as this value is positive. So as long as our EVA value is positive, okay, company has increased in value. Obviously, in this question, they didn't ask us that, but they could ask you that, what is your commentary on the EVA? All right, any questions on this question? Okay, so I'm just going to answer some of the questions. Okay, so with the ad, yes, this is correct. Okay, so there's one question in the chat that's saying, can you please explain the ad credit losses again? I'm assuming you're talking about in the invested capital portion. Okay, I'm going to explain both. So we add back credit losses because we want to remove it from NOPAT. It's a non-cash item. Why are we adding? Because if we had calculated our profit, we would have minused it in the first place. How do I reverse that? I do the opposite of, okay? So that's the first thing. Why do I add it in my investor capital? Same thing. I want to affect or change my equity number because my equity of the prior year would have had that non-cash item in its profit. So to take it out, I must add it. Okay, so I've explained it both for NOPAT and investor capital. So hopefully that helps. Yes, I've answered that. Okay, so the question is why are we adding depreciation to NOPAT if it's a non-cash item? So what do you do in your NOPAT with depreciation? Do you add it or minus it? Okay, you are minusing it originally in my profit before tax. So to take it out, I must add it. I must do the opposite. Okay. Okay, and then the WACC, where do I get my WACC? In the question, it stated that WACC was 1/3 of the tax rate. Cool. All right. Okay, so why do we exclude? Okay, so can we explain why exclude sales commission? Because sales commission is a cash item. And remember, when we are dealing with this, we want to see our cash component. Our sales commission is cash. Even in practice, and salaries and wages cash. You're never going to pay people on credit. I mean, your business ain't going to say to you, oh, I'm going to pay you next month your salary. No, they have to pay you what you've earned. Same as sales commission. You earn that commission, you get paid cash. So it's a cash item. So we don't affect, it doesn't have any impact on no part. What do we do if credit losses are for end of year? It's still the same. The treatment's still the same. So the credit losses that we were dealing with was for the end of the year. The only reason why I took prior year's credit losses to add to the invested capital is because I'm trying to fix the previous balances, the previous equity balance. Because remember, invested capital, it's my opening balance of equity. So I need to change the closing balance of equity. And how do I do that? I use the prior year's credit loss. Okay, so it's got nothing to do with it being beginning or end of year. It's got to do with what am I doing? Am I doing my NOPAT? Then I use current credit losses. Am I doing my investor capital? Then I do prior credit losses. Okay. All right, so let's move on to the next question. Let me bring that up for you quickly. Okay, so I'm going to bring that question up now. Okay, so please confirm that you can see now learning unit 2 past paper question that says 9 marks at the top. Brilliant. All right. So this is how we can be asked to use a specific method. So remember, we've got formulas, we've got financial tables, and we have financial calculators. So this is a way that it can be asked to use a specific method. Right, so first thing we do is we look at our mark allocation. So it's 9 marks. So how much time do we have? It's 9 times 1.2. So you've got basically 11 minutes to complete this question. And it's very important that you keep to time with your finance papers, okay? Okay, next thing we do is we look at the required. All right, so this question actually had 3 parts to it or 2 parts to it. I just chose the one part so we can get a feel of how it can be asked. There is another part to this. So it says required. Calculate the future value of the cash flows of Always Bright Limited for the East London manufacturing facility using the financial tables only, assuming that the cash flows occur at the end of the period. Okay, so first of all, we know it's cash flows. We need to determine if it's a mixed stream of cash flows. If it is, then we know, great. Okay, we can use financial tables. Secondly, it's the financial tables. Because it's a cash flow, we're using the financial tables for a single amount. Okay, we know it's future value as well. and we know the cash flows are at the end of each year. Okay, these are all very important things because they affect the way we calculate. Okay, so let's look through the question. It says, Always Bright Limited, a company specializing in the production of rechargeable light globes, is considering whether to expand its production facilities to boost its sales both locally and internationally. It is considering building a manufacturing facility either near Richards Bay or East London to make use of the ports in order to ship its globes to overseas markets. They have asked for your assistance in helping to calculate both the present value and future value of the projected cash flows as provided below. Okay, so we've got Richards Bay and we've got East London, and they've given us the cash flows for some, and for some we have to calculate. Then they've also said, Always Bright Limited uses an opportunity cost of 12% per annum. So reminder, our discount rate for time value of money can be called discount rate, can be called interest rate, can be called opportunity cost, can be called cost of capital, can be called WACC, weighted average cost of capital. All of those refer to the discount rate. So when they say an opportunity cost of 12%, that is your discount rate. Okay, it's very important. Okay, remember, we are doing the future value of cash flows occurring at end of period. Okay, it's very important that we remember that. Okay, so the first thing that you would do is you'd need to draw your table. Okay, first column is going to have year. Second column is going to have your cash flow. Third column is going to have your future value factor. Why? Because I am calculating the future value. If I was calculating the present value, then I would do the present value factor. Okay. Then I'm going to have my future value. I'll just put FV. That's fine. Okay. Right, we have 4 years, 1, 2, 3, 4. And then we need to calculate our cash flow. Okay, so for East London, we're doing East London. So we don't forget which one we're doing. So like I said, this question had 2 parts to it. I'm just doing the one part, East London. Okay, our cash flow is negative 14,000. Okay. And so cash flow is 14,000. Then the second year says outflow equivalent to a fifth of year one's amount. Okay, so obviously it's asking us to calculate. So our calculation is the negative 14,000 times 1 divided by 5. Okay, because it's a fifth, so 1 over 5. That will give us our cash flow. Okay. Okay, so I basically have a negative cash flow of 2.8 in year 2. Okay. Then year 3, it's 20,000, so it's very easy, or 20 million, sorry. And I just include that value in there. Okay, very simple. Then for year 4, an improvement of 10% from year 3. So I've got to include my calculations. So I'm going to say 20 million times 1.10. Why am I saying 1.10? Because I'm saying that 20 million is increasing by 10%. Okay, there's different ways to calculate it. You could have also said 20 million times 10% and then add that back to 20 million. But this is for me, the easiest and the way that I know that I don't get it incorrect. So that's how I normally do it. Okay, so we're going to include here, it is the 20, 1, 2, 3, 1, 2, 3 times. Cool. Okay, now we've got to get our future value factor. Okay, what's important is we've got to go to the table. So I'm going to bring up the tables on the slide deck that I was showing you. Okay. Okay, so this is a table. And because I want the future value factor, I mean, this is the one in your textbook, I've got future value. It has to say future value. And if you can see here, there's nothing about annuities. Because remember, when I'm doing a mixed stream of cash flows, it's basically I'm doing a single amount for every year. Okay, so this is the table that I'm using. If you want to follow for it yourself, it's also in your textbook on page 60. This is where this is, page 60 of your textbook. Okay, so when we are calculating the future value factor, we need to look at our interest rate. So the interest rate for this question is 12%. And then we need to look at our period. Okay, so let's go back to the question. So remember, say it's 12% and the period. Okay, so now, because we are calculating the future value, we need to make sure that we are calculating for the future. So what I mean by that is in year one, because I'm receiving the cash flow at the end of year one, my future value is only in 3 years' time. Okay, so we need to say it's n minus 1 here. Okay, so what I mean by that, it's my future value. So there's 4 years left, minus 1 gives me 3. So when I go to my table, I need to find the n of 3 with interest of 12. Okay, so I'm going to write that down here. Okay, so I'm finding my future value where n is 3 and r is 12. Okay, so let's go back to my book. Okay, so I'm going here where n is 3 and I follow it and 12%, so it's 1.405. So that is what I'm going to include. Okay, so I'm coming back here and I'm saying 1.405. Everyone comfortable? All right. I'm then going to just multiply these two together and I get my answer. Just move this away. Sorry, it's, here we go, then you can see better. Sorry about that. Okay, 19.67. Perfect. Now we go to year 2. Okay, so I need to find my future value factor when n is 2 and r is 12%. Where do I get the 2 from? Because I'm saying in year 2, the future will be in 2 years' time. And why is it 2 years' time? Because in year 2, I'm receiving the cash flow or paying the cash flow at the end of the year. Okay, so I need to go back to my table. I go to year 2. Go to 12% and I find 1.254. Okay. And then I multiply the two. All right. Then again, find future value factor for year 3. Find future value factor where n is 1 and r is 12. Where do I get the n is 1? Because in year 3, I have 1 year left to year 4. And because I received the cash flow at the end of year 3, I therefore only have 1 year left. So n is 1. Okay? So then I go back to my table. I go to 1, interest where it's 12, and I get 1.120. Okay, and for the last one, we basically leave it at 1. Okay. And why are we saying that is because this value, the 22 million in year 4, is the future value. That is its value. It's not going to change. So we just leave it at 1. Then once we've done that, we sum it up. And we get 22218. And that is basically our future value. Okay, any questions on this? Just going to check if there's stuff in the chat quickly. Okay, so I know some of you okay, so there's still some people that are asking me about the capitalization or learning unit 1's info. I'll come back to you. How did I do year 1 for this? Okay, so cool. How did you do year 1? Okay, so there's a question about why is my cash flow negative? Because in the question, okay, so if I go back to the question, in the question, it's negative. Look here, it's got a bracket. So I've got to keep it negative. I can't change it and just make it positive because I want it positive. I've got to keep it to what the question has. So they will show you with a bracket or a minus that it's negative. Therefore, your cash flow is negative. So you've got to keep it like that. Okay. Okay, and then, yep, thank you. And then the cash flows. So the cash flows that we are working out. So the cash flows in the question. Okay, so the cash flows in the question are present value cash flows, and then we are working out the future value. How do I know that? Because the question asked me to calculate the future value of those cash flows. It told me that. So therefore, those cash flows have to be the present value. It must be. Can't be a future value there. Okay. Right. And how did I determine the factor stuff? Okay. Okay, so like I said, if you're working out the future value, you need to see if in year 1, let's see if I show my screen. If in year 1, how many years are left for me to get to the future value? And the future value is year 4. So if I am cash flow in year 1, it's going to take me in year 2, year 3, year 4. So that is 3 years to get to that future value in year 4. So that's where I get my 3 from. Also, because we're dealing with cash flows at the end of the year, this 14 million is received at the end of year 1. So I can only start counting the future or full year from year 2, year 3, and year 4. That's how I get 3. Okay. All right, so let me move on to the last question. We don't have much time. We're going to only get about 8 minutes. So I may run over because I do want to make sure we finish this question. Thumbs up if that's okay if we run a bit over. Okay, so I'm going to try not to run too over, but this question we must do is quite important. So we should finish it, but we'll run a little bit over. And just a question on, will it always work backwards? Not necessarily, okay? Because this was the future value with cash flows at the end, yes. But if it's a future value with cash flows at the beginning, not necessarily. If it's present value, we've got to understand what we're dealing with, okay? So it's not like, I suppose there is a specific method. You can learn the different ones, but it's also important that you understand, right? If I'm in year one trying to get the future value, it's in 3 years' time. Therefore, I use the factor in 3 years' time. Okay, but it's not always working backwards. It depends what they're telling you. Is it beginning mode? Is it end mode? Is it future? Is it present value? Okay, so the recordings, they should be available with this week because literally it's going to download when I'm done and then I just have to share all the content. So it should be available this week for you guys. Okay. All right. So let me get into that last question. Otherwise, we are going to run out of time and I really do want us to do that question. Okay. So I am going to bring up that question now. Give me a second. All right. So I'll share my screen in a bit and please just again thumbs up that you can see it so that we are all on the same page. Okay, can everyone see that? Just thumbs up if you can. I'm assuming that hand up means that you can. All right. Okay, so last question. Okay, so this is how we show the application or the manipulation of the formulas and the different elements of the financial calculator. So it's not a straightforward present value, future value one. They're asking it to calculate a different element. All right, so here, first thing we always do is our mark allocation. We know it's 23 marks. Okay, so we know it's going to take us that times 1.2. So it's 28 minutes to complete. Okay, I'm obviously going to try to speed through it so we can get it done quickly. And we look at the required next. So it says calculate the annual interest rate he will need to earn on the fixed deposit to reach his goal in 5 years' time. Okay, so obviously we have someone who needs to reach a goal. We want to calculate the interest, right? So it's not the present value, it's not the future value, it's not the payment, but it's the interest. Okay, so this is how they can manipulate it. For this question, I'm going to use the financial calculator method. Just because it is easier for this. And when you are working out a different element other than future value and present value, the financial calculator is the easiest to use. Okay, so let's read through it. So it goes, Mr. Bolt, an avid sports fan, would like to attend the Los Angeles Olympics. According to his travel agent in Champion Travel, who specializes in compiling sport packages for major sporting events, the current cost of an airline ticket is 25,000 Rand and is expected to increase at 7.5% per annum for the next 4 years and 6% per annum thereafter. You'd also need to pay separately for accommodation and tickets to the event, which is expected to cost around $15,000 by the time his final booking is down in 5 years' time. The agent has advised Mr. Bolt to work on an exchange rate of 22 Rand 50 to $1. As Mr. Bolt would need to save towards this goal, he has approached his financial advisor for advice. The advisors indicate that he can start investing 7,000 Rand at the beginning of each month in a money market interest fund for the next 3 years at an interest rate of 15% per annum, compounded monthly, and then withdraw the money and invest it in a fixed deposit for the next years, paying interest over 6 months. All right. Okay, so there's a couple of things going on here. First of all, we have a future cost. It's the cost of this attending the sporting event, which includes our airline ticket and it includes the accommodation cost. So that's the first thing. We've got to work out what is the total amount that we will pay, or Mr. Bolt will pay, for the Los Angeles Olympics, which will happen in 3 years' time. How much will that be? So that is a future value that we need to calculate. Okay, that's the first thing, right? Then the next thing we have to do is we have to then look at this investment that we're doing, where we are investing 7,000 Rand at the beginning of each month. So when we repeat an amount, it is an annuity. So we are repeating the amount. Okay, it's an annuity and at the beginning of each month. Okay. So we need to then calculate that to say how much would we get if we invested, so that we know what is the amount going into the fixed deposit, because the whole point is to calculate the annual interest rate we would need in the fixed deposit. Okay, so there's a couple of steps. So number one, future value of what the event is going to cost us. Number two, future value of what we will get out of the annuity that we're going to invest in. And then number three is what is the interest rates we need in the fixed deposit to get the amount we need. Okay, so there's quite a few calculations. Okay, so the first thing that we're going to do is we're going to do the future value, or the cost of our ticket, right? Okay, so that's the first thing we're going to do, cost of our ticket in 4 years' time. Okay, so because we're using the calculator, we're going to write all the different amounts. So we know what our cost of our ticket is now. We know what the interest rate is. We know what our N is. And therefore we can calculate our future value. Okay, so our present value for our airline ticket is 25,000 Rand. Okay. You can actually put it as a negative because we're going to pay that amount. Our interest rate is going to be 7.5% for the next 4 years. Okay. And we know the N is 4. Okay, there's no compounding, so I'm not changing my interest. I'm not changing my N. Okay, so if we punch that into the calculator, so we say negative 25,000 PV, 7.5 interest per year, 4N, and then we comp FV, we will get 33,387. Okay, then that's in 4 years' time. We then need to do the cost of our ticket in year 5. Okay, why am I doing that? Because here it said that the current cost of our airline ticket is 25,000, expected to increase by 75% for the next 4 years and then 6% thereafter. Okay, so we've got 1 more year. All right. So we basically bring down the same elements, but our present value now is our future value answer. Okay, because that's the value we have. I'm going to do it as a negative because it's a cost. Our interest is 6 now. The N is only 1 because it's only 1 year. And then we comp the future value, which should be 35390. Okay, are we done with all of our costs that we need for the Olympics? No. So total cost for Los Angeles Olympics is equal to our flight cost plus our accommodation cost. Okay. Our flight cost we know is the 35390 390. And now our accommodation cost is the $15,000 or dollars times the 22.5 Rand exchange rate that we are expecting in the future. Okay, if they hadn't told us that the exchange rate is expected in the future, we would need to get that amount. Okay, but they've told us here for this one. Okay, so 15,000 times 22.50 is 3C7,500. Okay, which then gives us the total cost that we need for this trip. So now we have the total cost of our trip. Okay. What do we need to do now? Now we need to work out how much are we going to get out from our annuity. Okay. So what is our annuity? Okay, so what will our investment be after the 3 years? Okay, again, we're going to put down everything. So here we got a PMT now. Okay, the one other thing that we must make sure we say is beginning mode. Okay, because remember they said that we are investing at the beginning, 7,000 at the beginning of each month. So there's also compounding, right? So our payment is 7,000. That's what we're putting in. Okay, our interest per year now, they said to us that for this, it's 15% per annum, compounded monthly. Okay, so we have to say it is 15 divided by 12. Okay, so we've got to say 15 divided by 12. Why are we saying 15 divided by 12? Because we are saying 15% compounded monthly is 12. Remember our formula, R divided by M. So rate divided by the compounding. Okay, which gives you 1.25. Then our N, we have to do the same thing. We know that we've got 3 years, but it's been compounded monthly. So we need to say it is 3 times 12. Okay, so remember someone asked me earlier, how do I factor in compounding on the calculator? This is what I'm going to do. I'm going to say 3 times 12. I'm going to punch in 36 into my calculator. Okay, and then when I do the future value, I should get 319,756. Okay, are we done? No, because we still need to calculate what our interest rate would be. Okay, so for our interest rate calculation, we need to make sure we copy down all the elements. Lucky for us, it's no beginning mode, so we are good to go. Okay, so how much are we putting into the fixed deposit? So remember they said we're going to invest in this annuity and then take that money and invest it in the fixed deposit. Okay, for the next 2 years paying interest every 6 months. It's also compounded. So our present value here is the 3196. It is what we calculated because that is what we're going to take out from our investment and put in. What is our future value? Okay, our future value is the amount that we want to take to the World Cup. Okay, so it's a 372, not the World Cup Olympics. It's the total amount that we need, which is a 372,980. Okay, what is our N? It is 2 times 2. Okay, where do I get 2 from? It's 2 years Where do I get 2 from? Because we are paying interest every 6 months, so twice a year. Okay, which then gives us 4. Okay, then our interest per year is equal to, we calculate that, we should get 3.92%. Okay, but we're not done because this interest is a compounded interest. It's an interest compounded twice a year. So to get the annual interest rate, and why do I need to do that? Because the question said, calculate the annual interest rate. That's what it said to me. It didn't say calculate the compounded interest rate or the effective annual interest rate. It said calculate the annual interest rate. Therefore, the annual interest rate needs to be my 3.92 times 2. Okay? To 7.8%, 84%. Okay. Any questions? Okay, so we've run 8 minutes over. Yeah, so the PV is negative just because I want to, because I'm saying I'm investing. So basically what happens is when we invest, we pay money in, so it's negative. And then when we wait for the money to come out, it becomes positive. You don't have to, but it just helps sometimes with the calculator because some calculators can't compute like when you have your present value and future value together. If you don't put the one negative and the other one positive, it's not going to compute. So if it's just present value that you're putting in and you're computing a future value, you don't need to say negative. But if you've got both and you're computing interest, like in this last part, I have to show the negative. I have to. If I don't do show that negative, it's going to give you errors. Okay. No, if you do the form, you don't have to. Yeah, if you're using a formula, no. But if you're doing a financial calculator, yes. Okay. All right. If there's no other questions, that's really it for today. That's all I'm going to share with you. So like I said, I will share the slide deck, the recordings, the wall, the whiteboard wall with all the formulas noted. I will share the past paper questions we went through. I will share the solutions for those. I will also share the calculator guides for both Sharp and HP. So there's quite a lot you're going to get. And then I did drop my email address in the chat if you need to chat to me. I do normally come back to you. And then Mark's asked, how important do I think theory will be? So theory will always feature somewhere, okay? I mean, because your paper is only 50 marks, probably the most maybe 10 marks. Yeah, so I wouldn't not go through theory. I would definitely still go through the theory. Obviously, the most important aspects are the calculations. But if you're aiming, I mean, I wouldn't forego it because 10 marks could be the difference between a pass or fail or a distinction or non-distinction. So I always want to make sure you know the theory. And obviously going forward, theory becomes more important because obviously with these tests, it's only 50 marks, but in an exam, they can definitely give you theory. Okay, so the 3.92% is the interest. Okay, so the 3.92% is the interest that we're calculating, the annual interest for investing in the fixed deposit. Okay, The 3.9% is a compounded rate. It's the effective annual rate. So it's already showing that you're compounding twice a year. So because the question asks you for an annual interest rate, we have to multiply it by the compounding factor, which is 2, to get it to 7.84%. Okay, I hope that answers that question. Okay, everybody, that's it. I do have to go now. But like I said, just pop me an email if there's any questions, and I'll share all of that. The test is closed book. Oh, I didn't show you the formula sheet, Caleb. I forgot about that, but I'll also share an example of that with the content I share with you so that you have that. Everybody, thank you so much. Bye.